The other thing that I would mention about negative rates is that they don't work. I mean, we have 20 years of data in Japan and close to 10 in Europe now. I mean, it hasn't worked. It's destroying the banks, doesn't support the economy, and it massively distorts the flow of capital. So I think it would be a very bad economic development for the U.S. economy to kind of import these policies that hurt the economy, hurt capital markets, and really, other than bringing cheaper borrowing costs for the government, don't do anything.
Thanks for watching this RTD interview. Don't forget to pick up your RTD Scary George round, only available at stbullion.com. Now enjoy this interview. Welcome to Rethinking the Dollar. Today I'm excited to have first-time guest, Mr. Vincent Deluard. He's the global macro strategist for INTL FC Stone. Today he's joining us to share his thoughts on the global economy as well as a variety of other subject matter. So Vincent, welcome to Rethinking the Dollar.
Hi. Well, thanks for having me. It's good to be here.
Well, I appreciate you taking time out of your busy day for us. Definitely want to get your thoughts on a variety of subject matter. And so before we dive any further, for those that may not know Vincent Deluard, can you give us a little bit of your background and how you've arrived at this current point in your career?
Sure. So I've been doing equity research, mostly global macro research, for 11 years now. Initially, I started by tracking fund flows, supply and demand for the stock market. And then for 10 years, I covered European equity markets. And I joined INTL FC Stone about 2 years ago to launch their global macro product. INTL FC Stone is a NASDAQ-listed broker-dealer. Thought it'd be relevant for you. We're the largest broker of physical gold for institutions. And I write for them weekly reports on pretty much any topic I like, which lately has been a lot has been about currencies and interest rates.
Okay, understandable. I appreciate you for sharing that. And so I want to kick this interview off with just asking you a simple question. We're well beyond the halfway point of this year. As a strategist, you keep your eyes on a variety of subject matter. What are some things that has you concerned about the global economy at this current point?
Well, maybe I'll start with something that does not have me concerned, and is the yield curve. I mean, it's been obviously the focus last week. I mean, when we had this near interest rate inversion on Wednesday, you saw the Dow drop 800 points in a day. And you see all these headlines saying, oh, the yield curve inversion has this, kind of perfect track record. And, if the yield curve is inverted, then that means we're going to get a recession within 6 to 12 months. Now, let me be clear. I have no idea whether we're going to have a recession. I mean, certainly the economy is slowing. It doesn't seem to me that it's going to be a recession, but I don't think the yield curve really means anything. If you look at the track record historically, it hasn't worked in the UK, it hasn't worked in Australia, it hasn't worked in Japan. So I really don't think it's a valid signal. The other thing that worries me about this kind of, when you see everyone look at the same thing, it usually doesn't work. I mean, that's reflexivity, right? In capital markets, if everybody uses the same rule, that rule no longer works. And certainly you can see that it's very possible that just because the yield curve is such a topic of focus, that its message is clouded. And then the third part that makes me discard that message is, I think the bond market, especially the government bond market, is completely insane. I mean, yield curves are being manipulated all around the world. We are in a very late stage of a massive bubble in sovereign debt. I mean, I'm sure you've seen all the reports about 16 trillion negative debt and counting. You see Germany. I mean, Germany has an inverted yield curve, but it's negative. What does that mean? Does that make it positive? So I think that, taking your cues from the bond market, it's kind of like asking for a stock tip at the crazy house.
Now, a lot of other commentators always mention, and they tend to bring up a lot of other indicators that are flashing red. And so we have, a contraction in the manufacturing output, and so all those other things that, well beyond my pedigree. But yet, are those things that play along with the yield curve inversion that could signal some things as well, or no?
Well, I mean, there's no doubt that there has been a bit of a slowdown in the economy. Partly, you had this huge tax stimulus, and growth is always 1 year versus the other year. So in 2018, that was a tailwind because you had the effect of the stimulus, and now it's a headwind. So you have the year-over-year effect that's working against you. Some weakness in manufacturing, some weakness in the global trade data, which is mostly self-harm. I mean, it's because we started these trade wars. I mean, it could end just as easily as it started. The part to me that is probably more important for the US economy is the consumer, and that's the part that has shown the most resilience. You've certainly seen the earnings of Target, a bunch of other retailers have done very well. That's what the US is. I mean, fundamentally, the US is a consumer-driven economy. So without the consumer kind of falling off a cliff, it's hard to see the US falling in a recession. But again, anything's possible. I wouldn't say it's that much more likely now than it was a year ago. And again, I think a lot of the reason for both the weakness today and the strength last year, last year everybody was talking about this globally synchronized recovery, right? I mean, the entire world was going and stock markets rallied and so forth. It was because the dollar was weak. And this year, we have a lot of headwinds globally, and surely some of that is due to the trade wars, but a lot of it is just because the dollar is stronger, and a strong dollar acts like a headwind for growth in China and emerging markets and other places like that. So a lot of the economic growth outlook to me is going to be dictated upon the direction of the dollar.
All right, now the direction of the dollar, great subway right there, because is it true that the strengthening dollar also puts somewhat of a tight pinch on the emerging markets, as you mentioned, when it comes time to pay back some of those debts, especially if their currencies aren't doing well, such as what's happening in Argentina and as well as other countries? So is a strong dollar necessarily good for the world? And it definitely is good for consumers here, but isn't that going to be a problem at some point?
Yes, no, it is a big problem for much of the emerging world, because we had this basically massive borrowing binge after 2009, when so the US was extremely overvalued, the dollar was overvalued after the 2008 crisis, and then the Fed anchored rate at zero, did QE, and that pushes this wall of liquidity into emerging markets, so they borrowed a lot in US dollar. And when 2014, 2015 happened, we had the normalization in the US economy was picking up, the dollar started to strengthen, and and the commodity prices collapsed. So all these emerging markets ended up having to repay very expensive dollars at the same time as their economies were slowing, and their dollar revenue, which were usually rated the price of some commodity, you can think of Chilean copper, Russian oil, that were collapsing. So that has created that squeeze. And again, pretty much since then, if you want to know what growth is doing, look at the dollar. Now, as far as the US goes, as you mentioned, a strong dollar is good for the consumer. In some way, it kind of helps offset the cost of the tariffs, which gives some credence to Trump's claim that China is paying for the tariff, because as long as the dollar appreciates, it's true that, to some extent, the purchasing power of US consumers increases. But it's very bad for jobs, for employment, and for exporters. And that makes me think that as we get into 2020, as the race heats up, Trump will have a very strong incentive to try to weaken the dollar, and you can certainly see that already in his communication. You take out the trolling about Greenland and stuff like that. Like, the message has been more and more on point. Oh, the dollar is too strong. Our trade partners are ripping us off, and so forth. So, to me, that kind of gives me hope that eventually we see some sort of resolution. Not necessarily on trade, because it's a hard issue, but on currencies. So the trade wars will move into currency wars in 2020.
In 2020. And so my question would be, with the trade war situation, as a strategist, as one who looks at the entire picture from both sides, will there be a solution to this trade war? Will it be a situation where the U.S. can, I guess, somehow offset the deficits in regards to trade, or the trade deficit in regards to trade? How will this resolve, in your opinion?
Well, most likely, I mean, if you look at the general China-US relation in terms of like two superpowers fighting for domination, there won't be a resolution. It's going to be fought over many decades, if not centuries. As far as the trade issue, it's both easy and hard. I mean, it's easy in the sense that, we kind of started this, so we could just end it. And I mean, certainly whenever Trump's done things like at the G20 in Osaka, say, hey, actually, I'm not going to do this, we're back. It's a lot harder if we want China to kind of change its practice, because they view that as encroaching on their sovereignty, and they'd rather just kind of drag their feet and wait it out. So to me, if it is going to be solved, the fastest and easiest way to do it would be to do a tit for tat, remove the tariffs in exchange for reevaluation of the RMB. So use the dollar as a tool in that bargain. So you saw how, the exact opposite of what happened in early August when Trump slapped 10% tariff, and then China after that let the yuan go through 7. So do the other way around. At least a stable yuan, or at least, or maybe even appreciated. And that's very much what Ronald Reagan did in the early 80s. There was a Plaza Agreement at the time. The offending party was Japan and Germany to a lesser extent. And basically what Ronald Reagan did is that he got the finance minister of Japan, France, I believe Germany as well, got them in a room in the Plaza Hotel, which may have been owned by Trump at the time, and told them, guys, if you do not agree to revalue your currency against the dollar, I'm going to slap tariff on you. I think that's something that Trump could very well do in the next months, as he finds that the other battles that he's taking, trying to fight the Fed, trying to fight China on the tariff, are really hard to win. That is something that he can do.
So it looks like he has a lot on his plate as far as the battles and things he's started in this whole concept of Make America Great Again, and the whole idea of getting the better half of the deal. I mean, that's one thing I think that if he doesn't see this through, it can come back and shoot him in the foot, especially as we get into the presidential season. And so you touched on something a while ago in regards to debt. And so at this current moment, we were told that we were in economic expansion by our president via Twitter, but yet I think the mainstream is starting to feel something different. But yet the deficits continue to increase. The debt ceiling has been somewhat removed, abolished, halted, or whatever. And there's talks about tax cuts to help offset the slowdown or whatnot. How will all that play out? Will the deficits continue to grow? How problematic will it be in the days ahead? Because once again, 23 trillion and counting, will it be paid back?
No, I mean, public debt never gets paid back. I mean, I would expect it to keep growing. I mean, if you look at the CBO, the Congressional Budget Office, they do this kind of like 5-10-year forecasts. And I mean, the biggest drivers of the U.S. deficit at this point are entitlement and Social Security, right? And these are things that are not going to change. I mean, you have all these boomers. I can't remember what the exact number is, but you have millions of boomers retiring every year. And, when they were working, they were putting money in. Now they're going to put money out. So this is just a demographic reality that the deficits are going to increase. Now, of course, if we do stuff like, removing the more tax cuts or taking money, reducing the Social Security contribution and financing it with money from Social Security, you're just going to make that, faster and faster. And that certainly has been the path we've been under the Trump administration, right? I mean, we are this, 11th year, 10th year economic recovery, and we have a deficit to GDP of 5%. That's something that we've never seen. Now, I think it will be a concern at some point, but, we are, I mean, the bond market is telling otherwise, right? And the bond market is really begging governments to take their money. I mean, you look at a place like Germany, it was insane. It was, I think, yesterday, or 2 days ago, they have an auction of 30-year Bund, 0 coupon, high price and negative yield. Meaning that the deal was, okay, well, you pay me 103 today, and I'm going to give you 130 years. I mean, this is people begging to be stolen. In a way, like I don't think it's good, but I can certainly understand the temptation. I mean, if people are fools, it's tempting to abuse it.
Now, my question is, without really knowing the details of the investment realm, what type of entities would be willing to buy that? Because what I'm hearing is a lot of pension funds and retirement portfolio assets are the ones that kind of, purchase those things. Now, if the world is going negative as far as just the yield on bonds, how does that make any sense on increasing those promises paid to investors in the future when it comes to retirement, especially?
It does not. I mean, I don't think there's any way the math can work. I mean, I know the European system more than I do the U.S., but I mean, if you're the portfolio manager for a pension fund in Europe or an insurance, and your problem is you have these liabilities that are very far out, right? Because you need to pay pensions for 30, 40, whatever X years. And there's not that many assets that are on the curve. And you also have regulation that tell you that you need to own government bonds. Like they won't let you, for example, it'd be crazy, but you could buy Argentine debts. There you get a yield, right? I mean, you may not get your principal back, but you're going to get some yield. But generally, prudential regulation makes that very costly, and they tell you, no, you have to buy domestic debt. So what do? I mean, you do what the regulator tells you, and you go out there and you buy that 30-year term yield. And virtually ensuring that you won't have the money to pay your policyholders when the bills come due.
Man, that's very scary, but that's reality. So unfortunate. But yeah, let's get into a little bit to some issues here. I'm curious to find out your thought in regards to this back and forth between President Trump and Jerome Powell. He's very vocal and basically calling him out, saying he doesn't know what he's doing. He's behind. He's behind. You know, he said everybody's cutting rates, and I saw that Switzerland today has the lowest Fed funds rate at, I think it's 0.08. And so those are, it's five nations.
Negative, yeah.
Yeah, in the negative. Yeah, in the negative. There's 5 nations right now, pretty much all in Europe, that are negative. And I think Trump wants to compete with them. So how would that work?
Well, and to some extent, Trump has this odd way of communicating, extremely irritating, and seems a little bit like a bully. But he does have a little bit of a point as far as the U.S. Powell raised rates a quarter 8 times in a row when the entire world stayed at 0 or below. So you got this very unusual situation where the U.S. had the highest, or close to the high, outside of emerging markets, had the highest yield in the world, right? You had generally Europe and Japan were below 0, Australia, the UK, New Zealand were around 1, and then the U.S. 2-year yields were trading close to 3% back in November. 10-year was at 3.2. And really, what the world was saying is like rates are too high in the U.S. And Trump's been hammering that message. It seems to me that Powell has listened. He has to walk a fine line, or he has to keep the fiction that the central bank is independent, but at the same time, as the head of central bank is appointed by the president, and so board members. And he's been kind of walking back. Will it go negative? I don't think so. I still think we have this pretty good, nominal growth in the U.S., certainly much better than anywhere else. So that justifies, maybe cutting a little bit, but certainly not all the way to 0. The other thing that I would mention about negative rates is that they don't work. We have 20 years of data in Japan and close to 10 in Europe now. It hasn't worked. It's destroying the banks, doesn't support the economy, and it massively distorts the flow of capital. So I think it would be a very bad economic development for the U.S. economy to kind of import these policies that hurt the economy, hurt capital markets, and really, other than bringing cheaper borrowing costs for the government, don't do anything.
Very true. But yeah, one thing I think that on the people who will lose out are the people who unfortunately possess large amounts of the currency itself, as it is devalued along the way. What are your thoughts on the future of the dollar? And so we know a lot of nations, they coined a term, de-dollarization. We have China, Russia, everyone's coming up with alternative payment systems and so-called gold-backed cryptocurrency. So all those things happening right now. Is the world running from the Federal Reserve note as a result of this policies that's been in place?
Well, I think so, and it's not just the. I think not only the desire to do that is there, the desire to de-dollarize there. I think putting it in practice is harder than just like wanting it, but there has certainly, I think, never been a stronger consensus to move away from the dollar, and it's not just because of the Fed. It's really, I think, mostly about sanctions and the I can never say this word. The fact that the U.S. Regulation enforcement agency can punish people outside of the U.S. jurisdiction. So you're a French bank and you do business in Iran, then you can get sanctioned because you use the dollar in the transaction, even though you've complied with all applicable law in your jurisdiction. That is a huge disincentive to use dollar and a huge incentive to come up with something else. So you've seen, you mentioned Russia and China. So I think some of their trade in yuan. I think, 2 days ago, I saw that Rosneft, Russian oil producer, is going to start invoicing in euros. The Europeans have set up that little payment system with Iran to go around the sanction. So these are trickles. At this point, none of these things are, it's going to make a big dent, right? But they start to exist. And I think that, that is the biggest long-term threat to the dollar is, whether we have kind of, we will reach critical mass, and we'll get to a point where, I mean, you look at a lot of emerging markets, the biggest client is China, not the US, both on the export and on the import side. So why use a third currency to transact? So why sell, why are you going to sell your copper in dollar and then turn this dollar into yuan so you can buy Chinese manufacturing good? Wouldn't it be just easier to settle in yuan? And I think that's eventually where it's going to happen.
So I want to talk about what appears to be getting a lot of attention in the mainstream news now more than ever, and it happens to be the sudden spike in the price of gold and silver. And so you work for one of the biggest gold dealers, as you mentioned, broker dealers, as you mentioned. What's been activity on your end? Are you seeing spikes, and why is that? And are people looking to hold physical or buy products or what?
Well, both. I mean, the biggest reason has been this kind of dovish pivot of the Fed, right? I mean, the biggest problem with gold is that it doesn't have a yield, right? So, I mean, it's costly to hold and it doesn't yield anything. Well, if rates are going to fall to zero or below, that flips, right? I mean, you look at, a place like Germany or Switzerland, if you keep money at the bank, they're going to take a chunk of it every month. Well, if you own gold in a vault somewhere, no one is going to go like, take a little bit out of it. So as rates fall, I think you have this, natural tendency to go towards gold. And then there may be also be kind of a geopolitical aspect to this, like a gold. I don't think people should own gold for price appreciation necessarily, even though I do think it will eventually go higher, but just as an insurance policy. I mean, when the Dow was down 800 points last Wednesday, the only things that were up were the Japanese yen and gold. And I think I don't know how this situation is going to evolve with trade with China, with Hong Kong, with Taiwan, and all the other hotspots. But certainly there's this perception that a lot of these issues are escalating. It's not very clear that the actors who are in charge of them have the cool heads or even the desire to cool things down. So gold benefits from that.
What are your thoughts on just the gold to silver ratio? Is that something that you consider as far as silver being a little bit more of greater value because it's a lot cheaper, or does that ever factor in regards to just portfolio allocation of the metals?
Right. No, that's nice. I mean, the concept of value when it comes to precious metal is difficult, right? Because precious metals don't really yield anything, right? I can understand the value of a stock, like you bring it to earnings, even of the bonds to yield. Well, what's the value of a precious metal? I mean, the value of the value of crypto, it is whatever people are willing to pay for it. So it's kind of hard to make a value case. That being said, yeah, I mean, silver is trading very close to all-time low. It's starting to outperform. So if you believe in technical analysis, it certainly looks good. Generally, I mean, silver has kind of this higher. It's gold on steroids, right? I mean, if gold does well, usually silver does better. By the way, that works the other way around as well. So when gold goes down, silver usually goes down as well. So I mean, surely, it makes sense, I think, to have an allocation to both. The ratio may go up or down, but they both represent some sort of a hedge against black swan events.
Now, before we wrap things up, I'm curious. I came across our article I believe you wrote in regards to the Millennials and FANG stocks, and so can you share with a little bit of that subject matter there? Because I think I like to reach out to the younger population and just give them different ideas and concepts on the concept of investing. What's your opinion on that?
Sure. So I was just struck by an observation that in 2009, when the S&P 500 closed at, I think, at 666 on intraday March, the average millennial was 20 years old. And today, when the S&P 500 is close to 3,000, he's 30 years old. And this decade, when you're 20 to 30, this is what demographers call the coming of age decade. It's probably the most foundational moment. And from an economic perspective, it's especially important because that's when your income goes from zero, because at 20 you're in college or at home, or if you work, you have a very low wage, to being in your 30s, and it's where you hopefully by this time have a steady job, make good money. So the growth is infinite, right? And a lot of that growth is also very discretionary because you don't have kids yet, you don't have a mortgage, you don't have to take care of your parents. So you have all this discretionary income that's growing very, very fast, and you're going to spend it on new consumption items. And for the millennials, these new things where, binge watching shows on Netflix, buying the latest iPhone, buying everything on Amazon Prime. What's the other thing? I don't know how people spend money on Instagram, but certainly they post a lot of pictures of themselves there, and so forth. So the FANG stocks were able to capture this massively rising tide. Remember that the millennial generation is the largest generation in US history. There are more millennials than there were boomers. And every year, the discretionary income of the millennials going 20, 30%. And so was the top line of these companies. Now, like I said, the average millennial is turning 30 years old. I'm actually on the older side of it. So getting close to 40 now. And when you're at that age where your earnings don't rise as fast, usually you have finally bought a house, and the millennials kind of did that later than prior generation. So that's really happening now. So instead of spending your money on discretionary stuff, you're going to spend on the mortgage. You have kids, you're no longer going to, spend as much money on fun stuff. You don't have to buy diapers, pay for school, and so forth. So a lot of the growth that fueled the rise of the FANG is kind of coming out. So you see that in Netflix, right? Last quarter, I think their number of US subscribers declined for the first time in history. They have to start raising prices in order to grow, which tell you they're becoming normal companies. And then even if you look at all 5 of the FANGs right now, over the past year, are all underperforming the S&P 500 index. It's never happened before.
So that's basically telling me, or from what I'm hearing, is that the next 10 years, possibly outside of all the things we've covered prior to now, could be very problematic for those companies, given the fact that Facebook, Amazon, they're all entertainment and not necessarily, they're not needed to sustain life. They're more so entertainment and luxuries. So the valuation of those companies might be in jeopardy moving forward.
Yes, and I'm glad you brought the term valuation. I'm certainly not suggesting, these companies themselves are at risk. I mean, most of them are great business. They generate tremendous cash flow. But, the question is always the price. And something, we went through something very similar in the 60s and the 70s. So in the 60s and 70s, we had this company called the Nifty 50. And these were like large cap growth stocks, very much like the thing of the time. So at the time it was General Electric, IBM, Coca-Cola, Walt Disney. It's kind of all American firms that were targeting this rapidly expanding middle class and the boomer generation. And they kept, the multiples kept going higher and higher. I think, by 1972, when they peaked, they were trading at around 70, 80 times earnings, which is pretty much where we are on some of the thing names. Think of Amazon or Netflix. And then after that, when you start from such a high base and your growth starts to slow, even though you're still doing well, I mean, most of these companies are still around today, that multiple goes down, down, down. And basically the multiple of the Nifty 50 came down all the way from the 70s to the 80s. And I would expect something similar to happen for the FANG in the next decades.
Wow, that's going to be very interesting to see how that unfolds, especially as we enter into a very questionable decade. So very last question, and I'll let you go. Jackson Hole's underway. No telling what's going to come out of there as far as policies implemented or ways of keeping this expansion going, which Jerome Powell loves to mention. Will there be quantitative easing coming, in your opinion? And how low do you see rates going in the next couple of months during this presidential cycle as Trump and the Fed go back and forth?
Good question. Will there be quantitative easing? Eventually, yes. For the reasons we discussed earlier, that the deficits are going to keep growing, mostly for demographic reasons, and simply the central bank is the only one that has the money to do something about it because it can print it. So eventually, yes, I believe you'll see quantitative easing. Will you see it before Trump leaves office? Probably not, but I wouldn't rule out anything. I mean, that's one thing that we've learned with Trump is that things can change very quickly. As far as rate cuts, a hard one. I mean, Powell has been kind of pushing back. I would be more interested to see what happens to the currency market. I think, if you really want to help global growth, what you need to do is to weaken the dollar. Jackson Hole is a great setting to do this. You get all the central bankers around the table, and you can kind of have a pact, right? Okay, well, you stop devaluing your currency, I will stop doing it, and that way, basically, kind of agree that maybe we get to let the euro rise, which is massively undervalued. We stop depreciating the yuan, and that would be a way to help global growth in 2020.
All righty, Vincent Deluard, I appreciate you for joining us here on Rethinking a Dollar. Can you give the audience a way to follow you and to keep a hold of and to find out more about what you do as a strategist or whatnot?
Sure. So, I mean, the best way really is to trade with our firm, INTLC Stone. We service customers around the world, physical markets, securities. A lot of our activity is institutional. If you're an institutional client of the firm, you can follow my research. If not, Twitter is great. Say enough. I mean, you have a lot of great minds on Twitter. I mean, it's incredible that this service is free, and forget the trolls, block some people, curate your list, and you can have a wonderful experience on Twitter.
Thanks for joining us. Enjoy the rest of your day.
You're welcome. I enjoyed it. Bye.